So partnership accounts, you can write and you can start writing and say that you find out a partnership, and you can write that this is a business, which is formed by two or more individuals, who engage in trading activities with an aim of making profits. With an aim of making profits. This is a business which is formed by two or more individuals who engage in trading activities with an aim of making profits. Then we have another point and say that a partnership is regulated. A partnership is regulated. A partnership is regulated by a partnership agreement. By a partnership agreement. Then another point we say a written partnership agreement. A written partnership agreement is known as a partnership deed. Is known as a partnership deed. It's known as a partnership deed. It's known as a partnership deed. It's known as a partnership deed. Then the examiner can ask you, what are the contents of a partnership deed? So content, a subtopic, contents of a partnership deed. Contents of a partnership deed. Contents of a partnership deed. Number one, we're gonna have profit and loss sharing ratio. Profit and loss sharing ratio. The profit and loss sharing ratio. Number two is the capital contribution. Capital contribution by each partner. Number three, we also have the rules and regulations. The rules and regulations for admission and retirement of a partner. If the word rules and regulation doesn't come, you can have the terms and conditions for admission and retirement of a partner. Then another one we can have it as the name and address of the partnership business. Name and address of the partnership business. Another one is name. That is names and addresses. Names and addresses of the partners. Names and addresses of the partners. You can also have another one is rate. Rate of interest on capital. Rate of interest on capital. Rate of interest on capital. And also we can have maybe salaries. Salaries to partners. Salaries to partners. Salaries to partners. Salaries to partners. And maybe also we can have another minor one. The rate of interest on drawings. The rate of interest on drawings. The rate of interest on drawings. interest on drawings, the rate of interest on drawings. Rate of interest on drawings. All right, so we continue. We continue and have another point, have a separate point. It says that a partnership business is required to prepare the following statements and accounts. A partnership business is required to prepare the following statements and accounts. It's required to prepare the following statements and accounts. And the first statement is the income statement. The income statement in many times is combined with what we call the appropriation account. The appropriation account. Another account which a partnership business is supposed to prepare is the partners. We call it partners capital account. And also we have the partners current account, and the final one is the statement of financial position. Statement of financial position. So these are the statements and accounts that a partnership business is required to prepare. So let's look at, we know what's an income statement. We have dealt with it before. We know what's a statement of financial position. We have dealt with it before. So let's highlight and give an information about these three accounts. So we can have the appropriation account. The appropriation account. The appropriation account. The appropriation account, right, and say that this is an account which shows how the profits of the business. This is an account. This is an account which shows how the profits from the business are distributed. How the profits from the business are distributed to the partners. How the profits from the business are distributed to the partners. How they are distributed to the partners. How they are distributed to the partners. It is prepared as shown below or as follows. It is prepared as shown below or as follows. So the appropriation account, we start with the net profit. We start the net profit. Then we add interest on capital. We add interest on capital for the various, for the given partners. Then we can have partner A and partner B. We add their interest, whereby we take the rate of interest to multiply by the amount of, this is interest on capital. We less, interest on capital we less. We add interest on drawings. Interest on capital we less interest on capital, less interest on capital. We also less the salary to partners, salaries to partners. Salaries to partners, we can have partner A and partner B. And then we add interest on drawings. Interest on drawings, we add interest on drawings, we add interest on drawings, we add. So what we get after getting there, or after putting into account the net profit minus the interest on capital, minus the salaries to partners, and adding the interest on our drawings, we get the profits to be shared by the partners. Profits to be shared. That is the profit to be shared. That's the profit to be shared. The profit of the partnership business is considered to be the profits of the partner. So it's shared among them. So what else you do is you share that profit between the partners using the given profit. and loss sharing ratio using the given profit and loss sharing ratio using the given profit and loss sharing ratio. So that's how we prepare the appropriation account. And in most cases, as I've said, it's combined with the income statement. So in Akujo, you will prepare the income statement and appropriation account. So that means once you get a net profit, you just continue, you less these items, and you add the interest on drawings. You also add the interest on drawings. Right, so we continue. We have the other account, which is the capital account, the partners capital account. Partners capital account. The partners capital account. The partners capital account. Partners capital account. We say this is an account which records the fixed contribution of capital by each partner. This is an account which records the fixed contribution, of capital, the fixed contribution of capital, the fixed contribution capital by each partner, and any other additional capital contributed, any other additional capital contributed. So let's see how it is prepared. Let's see how the partners capital account is prepared. So this is the partners capital account. We have the debit side and the credit side. Details, you see, we use the same A and B as partners. Details, that is A and B. And here we have the balance brought forward. That's the balance given given the information, the trial balance. Then also, if there is any additional capital, additional capital. Those are the two main basic items which you record under the capital account, Those are the two main basic items. That is the balance brought forward and the so that's a sample, or that's a format for the capital account, Then the next one is the partners current account. The partners current account. You write and say that this is an account which records the day-to-day transactions between the partner and the partnership business. This is an account which records the day-to-day transactions, between a partner and the partnership business, Records day-to-day transactions between a partner and the partnership business. Another point, write and say that it is debited with items, which reduce the benefits which go to the partners. It is debited with the items which reduce the benefits which go to the partners. It is debited with the items which reduce the benefits which go to the partners, e.g. drawings, comma, interest on drawings, and loss share. That is, if the business makes a loss, that loss is shared among the partners. Loss share. Another point. Write and say that it is credited with the benefits. Which go to the partners. It is credited with the benefits which go to the partners. It is credited with the benefits which go to the partners, e.g. interest on capital, comma, salary to partners. Next, the profit share. All right, EDC. So the benefits which go to the partners, that means those are, in other words, they are costs incurred by the partnership business for the benefit of the partners, like salaries. The partnership business are the ones paying, or it's the one paying the partner's salary. And on the capital that each partner contributes, the business also pays them an interest on that capital, and also they get a share of the profits which are made by the business, So as I said earlier, the profits of the partnership are considered to be the profits of the partners. So that's why it's shared among them. So the partner's current account is prepared as follows. We use the same partners A and B. What is the partner's current account? We have the balance per down. And sometimes the examiner can give you a question, with a debit balance of the current account, right? Yes, when dealing with the current account, you follow the directions of the question, right? Not always you'll find that the balances are credit. Sometimes you'll also be given a debit balance, right? Yes. So from there we have the interest on capital. We also have salaries to those partners. Salaries to those partners. We have the profit share. We have the profit. We have the profit share. Then on the debit side, we have drawings. And also we have interest on drawings. Interest on drawings. And sometimes the business may fail to make a profit. So if they don't make a profit, means they have made a what? A loss. So the loss is debit, the loss share. Then here we have the balance carried forward. So we have the balance carried forward on the debit side, and still you can also have a balance carried forward on the credit side. You can also have a balance carried forward on the credit side. That's according to how the question has been framed, according to how the question was framed. So those are the accounts and the statements that a partnership business is required to prepare, that a partnership business is required to prepare, that a partnership business is required to prepare. So sometimes a partnership may decide to change its terms, or they may decide to change their partnership agreement due to several conditions or based on some grounds. But that one will not cover now. Maybe to mention, partnership agreement may be changed. One, because of admission of a new partner to the partnership. Two, retirement of a partner. Then three, change of the profit and loss sharing ratio. But we will be dealing with those later. For now, I just want us to look at the basic foundation of a partnership, where no change is occurring. Okay. Yes, where no change is occurring. So from there, we can look and attempt to solve a question for a partnership. And we can have a question here, November 2020. We have November 2020. November 2020. We have November 2020. November 2020. Question 1B. November 2020, question 1B. So we go through the question, and it says, Andrew, Ben, and Christine are partners trading as ABEC partnership. The partners share profits and losses in the ratio of 3:1 after allowing for interest on capital of 10% per annum and salaries to Ben and Christine of 300,000 each per annum. So we have the interest on capital, the rate, and also we have salaries to partners. Then the partnership trial balance as of that 1st December 2019 was as follows. We have the capital accounts, we have salaries and purchases, accounts payable and accounts receivable, return inward and return outwards, discount allowed and discount received, We have the current accounts for each of the partners. We have general expenses, office expenses, budget written off, allowance for the debt, salaries and wages, rent and rates, land and buildings, plant and machinery, motor vehicles, and the accumulated depreciation for land and buildings, plant and machinery, and also for motor vehicles. Then we have the additional information. 1, inventory as at 31st December 2019 was valued at 1 million. That is the closing inventory. Allowance for doubtful debts is maintained at 10% of accounts receivable. So we take 10% of the accounts receivable, and what we get as the allowance, we will compare with the allowance for doubtful debts at the beginning of the year, and we'll take the difference. If the difference is because of an increase, we treat it as an expense. But if the difference is a result of a decrease, then we treat it as other incomes. Then information number 3 is that 31st December 2019, general expenses amounting to 200,000 were in arrears. That means they were owing. That means they were outstanding, and outstanding expenses or expenses in arrears, we call them accruals. And this was at the end of the year. Accruals at the end of the year, we add them to the general amount of that given expense. Then later on, we treat them as current liabilities in the statement of financial position. While rent and rates amounting to 100,000 was paid in advance. Expenses paid in advance, those are prepayments. Prepayments, we treat them as assets. That is under current assets. And at the end of the year, prepayments, we less them. The prepaid amount, we less it from the given general amount of that expense. Depreciation, that is number 4, is provided as follows. Land and buildings is 10% on cost per annum. That means we use the straight line method of depreciation, but we take the rate multiplied by the cost of that asset. Then plant and machinery is 20% on reducing balance per annum, and we take the rate, we multiply by the net book value of the asset. Net book value, we get it through cost minus the accumulated depreciation of that asset. Then motor vehicles, 15% on cost per annum. We take the rate multiplied by the cost. Required incomes, the statement of profit or loss, which is the income statement, and appropriation account for the year ended 31st December 2019, and also the statement of financial position, also the statement of financial position. So let's put that information down. So we have ABEC, ABEC partnership, the statement of profit or loss and appropriation account. Appropriation account for year ended 31st December 2019. We're given the figures in thousands. Given the figures in thousands. So we start with sales. And sales have a credit balance. You don't pick those amounts in the order of the items given there. If you follow the order, like sales and purchases, if you follow that order, you pick the wrong one. So purchases have a credit balance 10, so we pick 10,000. We pick 10,000. Then we less return inwards. Return inwards have a debit balance, so the order is correct. We less 400. That means we remain with 9,600 as net sales. As net sales. Then we less the cost of sales. We less the cost of sales. We less the cost of sales. Then we take the opening inventory. Opening inventory. And for opening inventory, we are given an amount of how much? Since you are not given inventory at the beginning of the year, yes, so that means opening inventory was 0. Then we add purchases. Purchases, we are given an amount of 6,000. We less return outwards. Return outwards reduce purchases. Return outwards of 200. Less, and also we less the closing inventory. The closing inventory we are given in additional information 1 as 1 million. The figures in thousands, so we pick 1,000. So this is 6,000 minus 1,200. Minus 1,200. That means we remain with a cost of sales of 48. So the cost of sales here is 48. So we less from 96, which is the net sales, we remain with 1,400 as the gross profit. The gross profit. Then from there we add other incomes. Other incomes. We have discount received. Discount received is another income. Discount received an amount of 300. Discount received an amount of 300. And we are not given any other income in that case. So that means from there we will less expenses. We less the expenses. We less the expenses, and we can pick the direct expenses first. We start with discount allowed. Discount allowed, we're given an amount of 200. Then we have the general expenses. General expenses, we are given an amount of 1,200, but we have an additional information for accrued general expenses. So 1,200, we add 200 on top, we get 1,400. We get 1,400. Then the next one is office expenses. Office expenses, we have 1,000. Office expenses of 1,000. Bad debts of 200. You have bad debts written off of 200. Bad debts written off of 200. 200. Let's jump first the allowance for doubtful debts, and we pick salaries and wages. Salaries and wages. The salaries and wages were given 500. We have rent and rates. For the rent and rates, we had an prepayment. So it's 200. Prepayment at the end of the year, we less 100. So rent and rates, nabaki 100. Then now we can calculate the allowance for doubtful debts, 10% of the accounts receivable, and the accounts receivable is 2,000. 2,000. Accounts receivable is 2,000. So 10% of 2,000, that is 200. Then we compare with the allowance for doubtful debts given at the beginning of the year, which is 200. So there was no increase or decrease. No increase or decrease. So that means now we can calculate the depreciation. Calculate depreciation. Depreciation. So we have for land and buildings. For land and buildings, 10% on cost. 10% on cost. That is 10% of 4,000. So that is 400. The next one is plant and machinery. Plant and machinery is 20% of reducing balance. The cost of plant and machinery is 3,000. We minus accumulated depreciation of 1,500. So 3,000 minus 1,500 we make with 1,500. Then we take 20% of that. 20% of 1,500 is what? 300. Then we have the last one, motor vehicles. You have the motor vehicles, 10% on cost. The cost for motor vehicles is 3,000. 10% of that is 300. 300. And those are the expenses that we have in this case. So let us calculate the profits made. So the motor vehicles, we must make 15% on cost. So the net profit is 550. 550. This is the net profit. That is the net profit of 550. The 550. And they also wanted the appropriation account. So we continue with the appropriation account. We continue with the appropriation account. So Chinituya, the net profit. Chinituya, the net profit. Did we have interest on drawings? No, we are not given interest on drawings. So let me record mine up here. The net profit is 550, right? We don't have interest on drawings, so we less interest on capital. Less interest on capital. Interest on capital for Andrew is 10%, and his capital was 3,000. So that is 300. Then we have 10% of 2,000. That is 200. Then we have Christine 10% of 1,500, which is 150. And also we have salaries to partners. Below salaries, the salaries to partners. And we have Ben and Carol who are paid salaries. So we have Ben 300 each and Carol 300. And Carol 300. Carol 300. So that means we'll get a loss to share, right? You'll get a loss to be shared of how much? Loss to be shared. And I hope we have gotten the same. net profit, all of us. All right. So let's tunabaki na loss ya ngapi?
700.
700. That is loss to be shared. That is loss to be shared. Then we share that loss now among the partners. We share it among A, that's Andrew, Ben, and Carol, using the ratio 3:1:1. 3:1:1. So that's a total of 5. So Andrew takes 3/5 or 700. 3/5 or 700, which should be 450, I guess. Yes?
420.
420, yeah?
Yes.
420. Then Ben and Carol get the same portion of how much?
140.
140. 140. 140. So that is a loss share. So that's how we share those losses. That's how we share those losses. So we share those losses. So far, any question? So let's prepare the partner's current account. Just prepare a sketch of it. Just prepare a sketch of that. The partner's current account. You have partner C, partner B, partner A. Then we have the details. Just having a sketch of that. It wasn't a requirement. Then A, then here we have the details. Current account. Current account. So let's record the balance breakdown. So the balances brought down, we have for Andrew and Ben, they are credit balances. 100 and Ben, 500, 400, but for Christine, it's a debit balance of 200. The debit balance of 200. Then you credit it with the benefits. The benefits, you have interest on capital. Interest on capital of 300, 200, and 150. That's what we have salaries. The partners, Ben, 300, and Carol, 300. Then we have the loss share. We have the loss share. So Andrew is getting 420, 140, 140, 140. So that means we're gonna have the balance carried forward. Balance carried forward. So we have, this is a total on the credit side for Andrew is a total of 800. On the debit side is 420. 800 minus 420. Ngapi? 380. That is 380. On the credit side of Ben, we have 400 plus 2 plus 3. That's a total of 900 minus 140. 900 minus 140. Yes?
760.
Then for Christine, 150 plus 300, 450. On the debit side, we have 340. That's a difference of
110.
110. So these are the balances for current account, which will carry forward to the statement of financial position. So let's do the statement of financial position and close on that question. So we have ABC. FBPC. Statement of financial position. As at 31st December 2019. The figures are in thousands. So we start with non-current assets. Non-current assets. So we start with land and buildings. Land and buildings. Take cost minus the accumulated depreciation minus the depreciation charge for the year. So land and buildings, we have what? 4,000 minus 1,000 accumulated. That is 3,000 minus the depreciation charge for the year of how much? Of 400 or 400. So it's 4,000 minus 1,400. Nabaki na 26,600. That is the net book value. That is the net book value. That is the net book value. Then the next non-current asset is plant and machinery. Take the cost minus the accumulated minus the depreciation charge for the year. So we have 3,000 minus 15 minus 300. So 3,000 minus 1,600. When with 1,200, that's a net book value. Then we have motor vehicles, a cost of 3,000, accumulated depreciation of 500. Then the charge for the year is 450. The charge for the year is 450. So that is 3,000 minus 950. Remain with 20. Yes. 20, 2050. Those are the non-current assets. So we key in the current assets. So the current assets, we have the accounts receivable. For the accounts receivable, the 2,000, we minus the allowance for doubtful debts. That which we calculated of 200. So we remain with 18. Remain with 1,800.
No, account receivable is 800.
Yes.
Account receivable is 800.
No.
So
account receivable, that's an asset. They have a debit balance. If you follow that order, you get the wrong thing. Okay.
oh, okay.
Accounts receivables have a debit balance. Is there just the same way as I said that under the sales and purchases, if you follow that order, you get the wrong thing also. Right? So it's key to note items or the balances of different items. Accounts receivable, payables. Accounts payables have a credit balance. They don't have a debit balance. So the accounts payables is 800. Any other asset that we have there in the trade balance? So additional information, CPA, prepaid, rent and rates. Rent and rates of 100. No cash, no balance at bank. That means those are the only assets that we have. So that will give us the total assets. Then, but before that, before we get the totals, we can do the other part, capital and liabilities. The other part for the capital and liabilities. We pick the capital from the capital accounts. For Alex, not Alex, Andrew is 3,000. For Ben is 2,000. And for Christine is 1,500. And also we pick the balances from the current account. For Andrew, I've gotten 380. For Ben is 760. For Christine is 110. Then we have the current liabilities. We have the accounts payable. 800. Accounts payable 800. And also we have the accrued general expenses. Accrued general expenses, additional information 3 of 200. Of 200. And I believe there's no other liability that we have left behind. So this will give us the total. That will give us the total capital and liabilities, total capital and liabilities.